That's your money saying it's time for a McDonald's run. Because with new McValue at McDonald's, you get more than you expect. Like buy a 6-piece McNuggets and add a McChicken for just $1. Your money says let's go. Get more than you expect with new McValue. Prices and participation may vary. Valid for item of equal or lesser value.
Reality radio for a really great future. We're talking real money.
Well, hello, friends. I'm Don McDonald, hanging out by myself here on Talking Real Money on this Saturday, or whatever day it is you're listening to the podcast later on. Thank you for tuning in. Thank you for listening. Thank you for your support and the fact that you tell folks about us and that word is spreading like wildfire. And we're becoming increasingly popular, and I'm really thrilled because I got to tell you, I have got some stuff for you today about the financial services industry. You wonder why I get so mad at this industry I'm in. Oh, these folks. But before we get to that stuff, I need to share with you a couple of things. One, the phone number, because I love helping you deal with money and understand it better. And to do that, I need to know some of your questions. I'll share information, but I want to answer your questions. And the number to call for me to do that is 855-935-8255, 855-935-TALK. Call anytime during the program when it's live. You can even call 24 hours a day, 7 days a week if something strikes you later on and you want to ask a question, because I'll answer it on the podcast. And if you call the live show, which is Saturday from noon to 2 Pacific, 3 to 5 Eastern, you will today get a free copy of my book, Financial Physics, saving you a whopping $8.99 over buying it on Amazon. Already a deal, but you got to call and ask a question. 855-935-TALK, 855-935-8255. Something else I want to share with you. You know, we do a lot of classes, and we do most of these classes in the Seattle area because that's where our firm is headquartered in Bellevue. But we know a lot of you aren't able to attend the classes, or the classes are too long. So we've always been about getting you a financial education. To that end, we have started to create video classes. You have to forgive me, I'm really cruddy today. I don't know why. We started to create video classes, the first 4 of which I put up on Talking Real Money last week. Just go to TalkingRealMoney.com and click on the guy with the TV head. You'll see it when you get there. It's a guy with a TV for a head. Click on that. That says watch a video, doesn't it? Doesn't that say that to you? And there are 4 classes up there. We'll add probably on average about 1 a week is the goal, maybe 1 every other week, depending on how many topics we have to cover. But they're going to tend to be short, between about 5 or 6 minutes and maybe 30 minutes. We don't want them to be ridiculously long, so we're going to break things up. And if you have a topic that you'd like taught about, let us know. Either give us a call or send a note in at TalkingRealMoney.com/contact, or just hit the contact button. It's really easy. Today, a couple of things came up. Well, during the past week, a couple of things came up. And they're all related to the bad behavior of the vast majority of the financial services industry in this country, and the people who call themselves financial advisors, who in fact aren't really anything. In fact, most of the time, they're a bunch of sales folks. How do I know that? I was one. There's no better way to know how bad an industry is than to have worked in it for a while. Nothing like experience. And recently, well, in the past year, the Securities and Exchange Commission has issued record fines to financial firms, to brokerage firms, financial advisory firms. And a lot of those fines have related to something that I have always abhorred. As a matter of fact, one of the former chairmen of the Securities and Exchange Commission called the practice of selling customers commissioned products, but hiding the commission. He called these funds sales load funds in drag. This is the B in the C shares. It used to be, just a little background, back in the day, there were only A shares. A shares, they didn't call them that, they were just shares. And they had a commission up front. It used to be 8.5%, then it went down to 5.75%, now in some cases 5%. But still, for a lot of advisors, that's uncomfortable. I don't want to tell people there's a commission. So they created B and C shares that have higher 12B1 fees. It's a fee to pay for marketing and to pay back commissions. And some of these funds, there's a C share, an Invesco Oppenheimer fund, the global fund, that has annual expenses of over 1.8% per year because the commission is included in the annual fee. Now, the SEC believes that should be better disclosed. Yeah, either that or totally eliminated. And so they, instead of punishing these firms, and they know they keep doing this, they know it, instead of punishing them, they just every once in a while slap them on the wrist and say, pay back the clients. And wait till you hear who the biggest violator was and who had to pay back the most to their clients. 855-935-TALK is the number. Tom's on vacation. I'm Don McDonald. We'll be back with more in a minute.
Tom and Don are talking real money.
Do you know what your investment risk tolerance is? Take our free no-obligation risk quiz at TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
Hi, welcome back. I'm Don. Tom's gone. I think he's probably camping out at the stadium waiting for the soccer game tomorrow. That probably is why he's not here. He wants to be in there early. 855-935-TALK is our phone number. If you see him, wave as you pass. 855-935-8255. We talk about money. We talk about life. We talk about things that are important, really important. And we try to make it all easier to deal with and cut through a lot of the garbage that exists out there. The lies, the outright lies. I mean, if you believe lying is not telling the whole truth, then one of the biggest financial liars in the country apparently is Wells Fargo. Because recently Wells Fargo had to pay back over $17 million in commissions that it collected through 12B1 fees through not disclosing them properly, which generally means not disclosing them. Let me just tell you, when I was with Dean Witter back in the day, years ago in the 80s, when I was young and really stupid, now I'm older and a little less stupid, we were told in sales meetings to sell these B, and we only had B shares at the time, we didn't have C shares, and we were told to tell people that they were no-load funds. No front load. But if you kind of forget to say the word front, and you only say it, and you're not being recorded, and you give them a prospectus, well, why quibble? And I would be willing to bet that that's still what's being done, because the insurance industry continues to lie when they sell you financial products and you ask them how much the commission is, and they go, there's no commission. No, the insurance company pays us. Such a lie. Where does the insurance company get the money to pay you? From the client. So Wells Fargo was the worst. RBC Capital Markets was the second worst. LPL third, Raymond James fourth, and then a bunch of other firms. So it's pretty common that financial services and advice firms lie to their clients. I believe, don't have anything to base it on except anecdotal evidence, because I don't think anyone's ever done a study, but I believe that the vast majority of the people in the financial services industry don't tell the truth, the whole truth, and nothing but the truth to their clients as they should. Why not just tell the truth? Oh, maybe because the truth is a lot more expensive than most people want to believe it is? They want to believe there's magic? There is no financial magic. And the sooner you stop believing in money magic, the sooner you are going to stop getting ripped off by people, taken advantage of by people, creating bad portfolios, getting involved in things that make the person selling it wealthy and not necessarily you. And oh my gosh, one of the worst offenders in this category, one of the very worst offenders in this category of liars are the folks who sell indexed annuities or equity indexed annuities or fixed indexed annuities or fixed indexed life or fixed, the names go on. Well, there is a lawsuit taking place right now against Security Benefit Life. Security Benefit Life issues indexed annuities. Now, most of the indexed annuities out there, most of them, are based on an index like the S&P 500. And what they do is they pay their investors, and I really do use that term quite loosely, they pay their investors a percentage of that return. It's either a participation rate without a cap or a participation rate with a cap or something like that. But there's a way that there's something going on in which they don't pay you the whole S&P 500 return. And it's never the real return of the S&P 500 either. It's the growth of that index over a particular very specific period of time, and then they'll pay you 80% of that up to a cap of 5% or 6% or 7% maybe. That's the normal way of doing these. The reality has been with indexed annuities that the average annual returns on every single one I've ever looked at ranges between about 3 and 4% per year, which is a pretty realistic number when you think about it. Okay, so your investment doesn't go down in a bad year, but folks, good years outnumber bad years by a pretty substantial margin. However, Security Benefit Life, they didn't want to say that there was a 80% or 70% or 50% participation rate in the S&P 500. No, they wanted to tell you, you get 100%. Wow. I get 100% of the index? How generous you people are. Don't you believe it for a second. Because they're not using the S&P 500. They are taking advantage of the fact that they know that you don't know the difference. So what they use is one of the things they use. It's almost made up. It's not really made up, but it's close, and that's what the lawsuit says is this is made up. They call it the index. It's the annuity-linked TVI index. Get this, I'm going to read you verbatim how one company explains this index. The annuity-linked TVI index is an index that tracks the Trader Vic index. No, that's not the grocery store. The Trader Vic index minus excess return, after deducting certain fees, costs, and expenses, and on a volatility stabilized basis. Index fees, costs, and expenses are 1.25% per annum and are deducted from the index. So I went back and looked at how this index has performed. Well, back in 2000 and let's go back here. Hold on, I'm going to take a break and I'm going to get you the exact numbers because it's really interesting what the performance of this index has been over the past decade or more, you're going to be shocked. 855-935-TALK. Get a free copy of Financial Physics when you call with a question.
Tom and Don are talking real money.
Download the advisor interview form and find out if your advisor's a fiduciary at TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
An insurance company is being sued by some of its customers for misrepresenting the potential of indexed annuities. There is a huge surprise. Really? These people lie? They do? They make stuff up? Yeah, these equity indexed annuities are tying their returns to a thing called the annuity-linked TVI index. The annuity-linked TVI index is really confusing. It's kind of a commodities index of sorts, but not really. And I went back to 2006 when this index was at $290 or $290. Not sure if it's dollars, but $290. And it did really well when the market was doing really poorly. By 2008, by 2008 it was 376. By 2009 it was at 342, so it went down a little bit. And by today, it's at 278. This index has not made anybody any money since 2008. So if you had an indexed annuity tied to this index, you made 0, 0, 0, 0, 0, 0, 0, and 0. That's exactly what the people stated in the lawsuit. We made 0. Wow, what a great index is that. By the way, since the S&P 500, from 2009 to now, the S&P 500 has gone from 260 to, I don't know, about 20, well, no, this is their, index. They're putting it at 231 on their scale to 912. I'm not sure what their scale is, but you would have made a ton of money in the S&P 500, and you would have made nothing at all in this annuity-linked TVI index. Who made all the money along the way on your money then? Come on, you know the answer. As always, who makes money in the insurance industry? The customers or the company? Always the company. They're not good at sharing. They're really not good at sharing. And they always try to find ways to avoid sharing as much as possible. To share as little as possible is the inverse of that. They don't want to share with you. They want to keep it. That's the whole idea. And that's why you should never, ever, ever buy an investment from an insurance person. Period. If it has insurance, an insurance company name, insurance in the name, annuity in the name, unless it's an immediate annuity, and you are playing the I'm going to bet against the insurance company game and hope I win, which you know you won't, but I understand why you play it. That's the only kind of annuity anyone should ever have anywhere. Now you need to go look at some of your statements. Do you see an insurance company name at your on your 401k statements, on your 403b statements, on your 457 statements, on your IRA statements, on your brokerage account statements? Do you see an insurance company name on any of those investment vehicles? If you do, you absolutely do not have someone who's looking out for your best interests, and you'll wonder why I get so angry at this blasted industry. They keep doing stuff like this, and they know they can get sued like crazy because they practically print money in the basement of their giant buildings. They practically print money. They can afford these little lawsuits and these little SEC judgments against them. Just the cost of doing business. We're making so much money, we don't really care. It's easier to lie and then apologize when you get caught. It is. It's easier for these companies to do that than to tell you the truth. And that's one thing you're going to find is totally different here. I mean, I've been doing this for 30 plus years, and the one thing I try to do is tell you the truth as I can find it. 855-935-TALK is the number. I'm not always right, but I try to tell the truth. 855-935-8255. Give me a call. Get a copy of Financial Physics.
Tom and Don are talking real money.
It may not be the sexiest website in the world, but it's your one-stop shop for real money information, TalkingRealMoney.com.
Reality radio for a really great future. We're talking real money.
All right, I'm through yelling at people for a while. For a minute, maybe. Because it just make me mad. I broke my pen. Oh, my gosh, I broke the little thing off my pen. Okay, I'm better now. Here's the deal. If you have a portfolio, an investment portfolio, and you're not sure you have what's best for you, well, call and I'll try and help you figure it out. That's why we do this. Just give me a holler at 855-935-TALK, 855-935-8255. If someone is trying to sell you some sort of an investment, call me before you sign. It's always better to do it before. Now, I promise you, if the advice being provided is truly in your best interests, I will tell you that. I know you rarely hear us say that, but every once in a while we do. We go, wow, that's a pretty good plan. The reason we don't say that very often is because, wow, they're mostly pretty bad plans. What most of you have is some sort of a wild hodgepodge that's either, you know, your broker or person saying, oh, let's buy this today, let's buy this today, let's buy this today, and let's sell that, let's buy this. Or it's you've been to multiple people and they all keep giving you different things or selling you different things. Nobody's giving you anything. So call 855-935-TALK and let's try and figure this out together. Because the one thing I can assure you is I'm not going to sell you anything. Even my firm doesn't sell commissioned products. We don't sell any commissioned products. We get compensated at our firm by a fee that's a percentage of assets. And it's one of the lowest in the industry of full service advisors. So we're not selling stuff. I promise. And when I tell people there's truly no obligation, you're not going to get sold anything, you have the security of knowing that we don't kick people off. We've never someone called up, oh, I want to talk to Don and I'm really mad. Good, be mad, tell me. I can take it. I've been a talk show host for 34 years. I can take it. I used to do political talk. Trust me, I can take it. And in that way, you know that that I'm not lying to you, because if I was lying to you, people would call on the air all the time and go, Don, you said such and it wasn't true. Well, if I say such and it isn't true, I want to be called on it. So the number is 855-935-TALK, 855-935-8255. And by the way, if you are buying or have purchased a fixed indexed annuity or an equity indexed annuity or whatever the things are called, do some research on the internet. You'll find that practically every article, I've gone through them, is anti-indexed annuities. The only piece I found that was pro was at annuities.com and was written by a guy who sells annuities. And he defends them with things like whataboutisms. I love whataboutisms. Well, yeah, what I'm doing may be wrong, but what about them? They're doing stuff too. This guy used the what about thing with, he was talking about people are complaining about surrender charges. He goes, yeah, well, what about the brokerage industry? They have declining sales charges and things. Yeah, that's wrong too. Unless you're fully disclosing it up front, which is never done. Hi, sir. Yeah, would you like to put $100,000 in our fixed indexed annuity that will give you the returns of the market with no risk to your principal? Oh, and by the way, if you want to get out in the first year, it's going to cost you $10,000. Is that okay with you, sir? We just buy it right? Nobody's going to say yes. Nobody's going to say yes. So what you say is, well, sir, I got this great new product. It's going to give you the returns of the stock market, and it'll never go down. Guaranteed. Won't go down. Guaranteed. You just get the return of the stock market, no risk. Now, you just hear that, and you're going, where do I sign? But that's a lie. It's just a flat-out lie. So before you do bad stuff, call me now, 855-935-TALK, 855-935-8255.
Tom and Don are talking real money.
Just about everything you need to know about money can be found at our website, TalkingRealMoney.com.
For your real life and real future, Tom and Don are talking real money.
It is real, and it's really important, and it's really yours. That's what we're talking about. This money is yours, and you need to know what the people you hire to work with it are doing with it and for it and what they're getting. You deserve to know for sure what they're getting, and that's the one thing very few like to tell you. 855-935-TALK is our number. I'm Don McDonald. Tom's on vacation. And let's go talk to Bob. Hi, Bob. Welcome to Talking Real Money.
Yeah, good day. Good listening to you.
Hey, Bob.
I'm recently retired, and I have some of my money that I had in a 401k from my company. I had closed that out and brought it over to an account that I have with Vanguard.
Mm-hmm.
And then I have some CDs, but I'm just, concerned about the CDs. I have a few of those, and I didn't know whether I should continue to just get those or just, at my age, I'm 74, kind of taper away from the investment part, get away from something more conservative.
Oh, how much money do you have? What kind of Vanguard mutual funds do you have first? Stock funds?
Pardon?
Which funds at Vanguard do you own?
I probably should have got my little paper out and had that ready.
Are they equity
they're
funds?
Pretty, yeah, they are.
Okay. And what percentage of all of your wealth, all of your liquid wealth, is in those equity funds versus the CDs?
Probably about 60%.
Okay, so you basically have what we call a balanced portfolio. You're a 60-40 portfolio. 60% in stocks, 40% in fixed income. That is not an overly aggressive portfolio for most people. Now, have you done any planning to determine how much is this money going to last you for the rest of your life, even if the market goes down some?
Well, between that and my required minimum distribution, my Social Security, if I continue to be frugal, I guess it would.
Yeah. Well, here's what I would do. I'm saying you're not in a crazy place. Just to let you know, if you're worried about the market at all, then you really do want to pare back slowly. You want to pare back those equities and either move into something like the Vanguard Total Bond Index or move into more laddered CDs. What I would suggest you do, it's really, 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 truly easy, Bob. Do you have access to the internet?
Yeah, I do.
Go to TalkingRealMoney.com and take our risk quiz.
Okay.
It's 10 minutes long. There's no sales pitch or anything. It's 10 minutes long or less.
Yeah.
It'll tell you about where you are on a risk scale. It's not going to tell you exactly, but it's going to give you a pretty good idea, which will help you determine what your risk tolerance is, which is really for most people, the determinant in breaking up their portfolio and in properly allocating it. So go do that.
Okay, well, I'm going to do that. I appreciate it. You've got that website. Go to TalkingRealMoney.com.
Yep.
TalkingRealMoney.com. And then, one other thing real quick. I had heard you just on the radio talking about those people that would talk to you about the annuities, fixed annuities, whatever you call them.
Yeah. Fixed index annuities.
And I had talked to somebody a while back. My wife and I went to this thing where they had that, and it just made me think pretty much of what you're talking about. They were talking about, well, you can't lose any money. That was their big pitch,
Right. And you get the returns of the stock market without losing.
Yeah.
Yeah.
Then you have a max and so on, but that's not necessarily the wisest thing, is it?
No, it's really not, and it's not true. It's more like a fixed annuity with just a fluctuating rate. So in some years you'll make nothing, and other years you'll make a little bit more, but the averages still come out to about 3 to 4% a year, which is about what annuities pay. But there's no big returns. So, go take the risk quiz. I think you'll like what you see. Okay?
Okay. Thank you very much.
Thank you, Bob. I appreciate the call. 855-935-TALK. 855-935-8255. Tom, welcome to Talking Real Money. Hey, Tom.
I want to start making some partial distributions or transfers, I guess, from my IRA to a Roth IRA. And I'm wondering, are there any risks? Do I put any of the non-transferred IRA money at risk for being treated as income?
Yeah, absolutely. Any money you move from a regular IRA to a Roth, where you're recharacterizing it from a regular to a Roth, is long-term possibly a good thing, but immediately any dollar you move from a regular IRA to a Roth is taxed at your regular income rate.
No, that portion I understand. But it seems to me there were some transfers that you made where if you made a partial transfer out of an account, suddenly you triggered something on the money that you already that you left in the account. That's not the case in what I'm describing.
No, that's not going to be the case. No, the only thing you're going to do, that's why I think it's so important before you recharacterize that you do a little pre-tax planning so you don't kick yourself into a higher bracket. But moving it generally long-term is a good thing for a couple of reasons. One, you never have to take an RMD down the road. 2, gross tax-free forever. 3, it's kind of nice to give it to your kids that way.
Yeah, that's my plan. Okay,
right,
I appreciate your answer.
I appreciate your call, Tom. Thanks for the call. 855-935-8255. I'm sorry, I didn't hear you. Todd. Okay, I had the name wrong. Todd, you're up. Welcome to Talking Real Money.
Yeah, I got a quick question. You might think I'm kind of crazy. 41 right now. I got about $180,000 in a money market fund, and then I have 3 401ks because I've never done anything with my 401 since I've moved over jobs. And I'm not quite sure what I should be doing with this money.
Well, what's the money for? Not the 401k, the $180,000.
The $180,000 is just money that I've saved up via work and put away on the side. And the 401s have been obviously for savings and retirement at some point.
Yeah, those are for retirement. The 401s, really easy answer is you're going to drive yourself insane with 3 401ks. So either you roll them all into your current 401k if you have really great investment options, or 2, you transfer them all to an IRA with either a 100% fee-only advisor, or if you're going to run it yourself with somebody like Vanguard. The $180,000, if that's long-term money, it's just wasting away in Margarita Moneyville.
Right,
and I've
had some friends kind of tell me I'm crazy with that, right?
It's a little crazy if it's long-term money because It's almost as if you're sitting there waiting for something to happen, a bell to ring that says, all right, Todd, time to invest. There will never,
well,
there
I
will
guess
never
the
be
thing
a
that
bell.
I've kind of done with it was I've assumed that maybe that I was waiting to see if the market may go down in the housing market.
I was right. Yeah, you're trying to time the market. Stop trying to do that. You're going to be in it. You're 41. You're going to be invested for a long time. Just keep putting money in, and when it goes down, you're buying on sale.
Tom and Don are talking real money.
Tom and I believe in helping everybody become a better investor. That's why we offer lots of free knowledge at TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Couple things. One, please check out our new video classes that are online right now at TalkingRealMoney.com. Just click on the guy with the TV head. That'll take you to those. Two, we don't do this very often, but we are, in fact, a fee-only, 100% fiduciary investment advisory firm that will do what needs to be done to get you to the best future we can imagine for you, that we can plan for you. We hold your hand and do those tough things that most of us don't like doing. So check us out at Vestry.com.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?